The daily chart of the 10-year yield I have here in terms of a index that plots it at 10 times. So for example, right now it's showing a present price of $39.97. That means the 10-year yield is at 3.997. With that in mind, let's take a look at how the 10 year has been moving, because with all of the changes in the air in economic data, another Fed meeting coming up in September, and the economic activity of this week, including just everything across the board, it's going to be important to stay on top of the 10-year chart so you can sort of get the slightest heads up when interest rates may take a turn either way or be forced to do so by Fed policy. So the first thing I want to look at here is on the daily chart. We've been coming down off of this high from April 25th, and you can see that this retraced 75% of the entire advance from April 2023 to October 2023. That's an important Gann number, and you can see that support came in. That support also aligned with a trend line, this one in red, joining the highs from December 11, 2023 to January 18, 2024. So now let's zoom into everything after this December low. We've got a bounce higher after yields tumbled on Monday and Tuesday, or I should say Monday and Friday from last week. But how far up might they recover? Well, there's two barriers of resistance. One is an orange trend line with origins way back here. Now, these are just regular old trend lines, all right? Not Gann fans or anything like that. And this line joins the April 6th, 2023 low to the May 4th, 2023 low. So this should be a hint to you to draw trend lines and keep observing them, because you don't know when they're going to be useful. This guy didn't really give us much to go on until now, and it's becoming resistance. And it's also sort of overlapping and coinciding with a more recent trend line from December 27, 2023 to February 1st, 2024. See how that's creating a zone of resistance? All right. So with that, what can we look at for what may happen as this recovery on the yields chart unfolds? Well, I had already drawn a forecast and it already kind of was said and done, but I can come in and draw a retracement of this move to see what are the levels up ahead that also coincide with important actual traded levels. So now I'm looking at taking the range down from April 25th all the way to August 8th, and you can see that we've retraced over 25%, but not yet 37.5%. You can see that most importantly, the 50% retracement is very close to this July 24th price spike. That is a very important type of resistance. And so the combination of those two makes this area here, which I'll move the label so you can see it better. This area around 4203, 4210 on this TNX.X chart. So 4.2 10-year yield will be an important area that may kind of cap the rally if it keeps extending. Now, before we even get there, right, we have to get past these trend lines. So that's the main two barriers. The current area where the trend lines are, which will be a dynamic support, or excuse me, dynamic resistance, right? It's going to keep changing value every day. But if it can clear this barrier, then after 37.5% retracement, 4.20 is the area to watch. Now, what if the yields resume lower before even getting close, right? Before they could get above 40.70, what if they start going lower? Then we watch this zone of support created by this range that was formed on Monday. And that includes the high of that level, 38.32, and the middle of it at 37.51. I'm now going to delete that other long-term 75% retracement and just focus on these levels here. So I think that there's a possibility for the 10-year to edge higher towards 40.70, but it's got to clear these two trend lines first. If it gets through that barrier, watch for a move back towards 4.2 over coming weeks. However, if it continues to remain capped by this zone of resistance, then I'd watch for a return back to 38.32. That would probably be the first rest stop, if you will, before it changes lower. Now, let me add one more new set of trend lines that you can monitor, and this is an approach called a fanning trend line. Again, this is not a Gann technique. This is just really elemental trend line stuff. So if you look at the decline from this high back in April 25th, you could draw a line connecting to the May 29th high. Then you can draw from the May 29th high to the next high, which was at July 1st. Then July 1st, it started to steepen up further. July 1st into July 24th. So see how this creates a fan? Now, how this can be useful is that if the yields continue to climb higher, those will be dynamic areas of resistance that may reinforce any of the levels that have been laid out by the actual price action. So that's something to observe in your markets, that start off with a more gentle fall, then speed up and speed up again. Any one of these individual lines, I'm not expecting to hold on its own, right? I'm not expecting it to exert pressure on its own. I'm expecting that if it lands in combination with another resistance on the yield chart, it might be useful. So let's keep an eye on this set of trend lines here, the orange and the green, as well as the levels, and of course, pay attention to the news. So we're wrapping up this week, ending August 9th, and then next week we have PPI, we have CPI. There's going to be more data that unfolds between now and the Fed meeting, which you got to mark your calendar. That's September 18th. It's going to be a very important day if we don't hear the Fed pipe up before that. And I'll be here with you, showing you updates, sharing what I think about the broad markets, things like the 10-year, the VIX, and more. Catch you next time.